Here we go. Drum roll please, for the PPI numbers. The producer price inflation numbers come in at negative 0.3. Oh, big deflation number there for month over month. PPI final demand negative 0.3. Big miss to the downside. That's very, very good. That's deflationary. Oh, here we go. Look at PPI core, 0. PPI core comes in flat instead of the 0.2 expected. This is very bullish. This reiterates a Fed complete pause right here. This is a hard stop for the Fed, in my opinion. PPI final demand year over year was expected to be 1.5. You actually got 1.1%. Big miss to the downside. PPI less food and energy, 2.8 instead of 2.9. PPI less food, energy, and trade year over year, you got 2.8 instead of 3.1. You did get a match on PPI less food and energy at 0.2. That was the expectation. But you take out food, energy, and trade, you're actually at 0. And you got a lower revision. PPI month over month, food, energy, and trade last month was 0.2%. You just got a lower revision from 0.2% to 0.1%. Holy smokes, the disinflation narrative is real. You could celebrate with me in, of course, the course member live streams, given that we have 4 phases of price increases coming up, with the first price increase on June 16th. And you could email us at staff@meetkevin.com. If you have questions, staff@meetkevin.com. Course is linked down below. Okay, but let's get into the actual PPI report. And I want to see what Wall Street is saying here. But this is all a handsomely positive report. This is very, very good. All of these numbers good with lower revisions. I mean, this is the best you could ask for. PPI is a leading indicator, once again, for CPI. So keep that in mind. As a leading indicator for CPI, in my opinion, this screams pause to the Fed. This should immediately lower the odds of the markets pricing in a Fed rate hike in July. We'll see what happens. It should also lower our 5-year break-even rate, our market expectations of inflation. There's no way inflation expectations should unanchor with this kind of producer price inflation report. This is excellent news. Very good. So I'm pulling up the producer price report right now, and then we'll go through some of the details to see where some of this disinflationary pressure came from. But I have to say, this is excellent. You've got the Qs reacting slightly to the positive. I'm not sure if, less people pay attention to PPI, but you have a slight positive move on the Qs in pre-market. Although I expect that a lot of your institutional investors are going to really wait to move for the market to open. So waiting for the BLS website to load on PPI. It's loading a little bit slowly right now, but we'll get that document in just a moment. In the meantime, I'm looking for any kind of reaction from Wall Street. So far, relatively quiet on the street, and we have waiting again for this. Let's see, waiting. Okay, I do have more prior revisions. Let me go through some more of these prior revisions while we wait for more data. More prior revisions. Year-over-year number last month was 3.2% for PPI X food and energy, came in at a revised 3.1%, so another revision down. PPI X food, energy, and trade, another revision down. Last month came in at 3.4, revised down to 3.3. Basically, everything that was revised for last month was revised down. Not only that, you basically missed on every single number except for one, which was a match. Everything came in low. This is absolutely phenomenal. The fact that you're at 0% month over month on food, energy, and trade month over month, excluded from PPI, really, really good. Nothing but positivity from this. This is very, very good. Let's look at the actual report now that we have it here. Producer price index for final demand declined 0.3% in May, seasonally adjusted. This is amazing. The decline can be traced to a decline in the final demand goods prices, which fell 1.6%. Goods falling 1.6%. That's great. Now, you did have services increase 0.2%, but that's probably one of the slowest increases in services that we've seen in a minute here. That's very good. No, we've been a little slower in the past here, looking at the chart over here. But anyway, 0.2%, that annualizes to 2.4%. That's not bad at all. That's very, very good. So let's see here. Let's get into some more detail here. Final demand. Final demand goods moved down 1.6% in May, the largest decrease since falling 1.6% in July of 2022. Most of the May decline is attributable to a final demand in energy, which dropped 6.8%. And this is why we look at more of the core number, right? And when we look at the core sector, what else can we see here? Well, we could see 60% of this headline number was because of a decline in gas prices. But what else also fell? Chicken eggs, jet fuel, fresh and dry vegetables, iron and steel scrap also fell. However, tobacco prices increased 1.7%. And there were some increases for electric power and for beverages and beverage materials. Coca-Cola, actually, we just went through as a team, we went through the Coca-Cola earnings report again, and they were complaining about commodities kind of sneaking up on them a little bit. So there you go, Steve. Look at Coca-Cola's commodities. Final demand services. So let's see here, services, prices for final demand services, less trade, transportation, and warehousing edged up only 0.1%. That is not a sign of sticky inflation. The fact that the only way you got to 0.2% of an increase was including transportation and warehousing. Warehousing is basically a negative anyway. Freight's in a recession, but transportation, some transportation services, as we saw in CPI, were hot. And if you remove these, the fact that you're only up 0.1% is insane. Although look at this. PPI, look at that. This is actually quite interesting. Transportation might have been hot on CPI, but not over here actually in PPI, because if you just look at transportation and warehousing, you're actually down 1.4%. So scratch that. That's actually a fantastic leading indicator for CPI. That is a great leading indicator right here on transportation coming down. So it must be trade. Trade is the only thing really propping you up over here for the 1%, and then some other aspects for the other 1%. Fine. Let's try to get some more categories to see, but this does not seem broad-based at all, which is good. I'm going to jump ahead. I want to get past the intermediate demand categories, and I'd like to get to some of the charts where we can get a little bit more detail on exactly where these numbers are coming in. No more revisions so far, which is good. Okay, we do have, here's a little bit of a Wall Street comment. That was a very dovish looking PPI print. Bonds are rallying a little bit, not as much as they sold off yesterday, though. So a slight move in yields, but not much. So the bond market not moving much, but definitely being labeled a, quote, very dovish PPI report on Wall Street right now. So looking at some of the more particular items here, what do we have? So let's see here. We're going to go to the seasonally adjusted month-over-month number on the right side. So our far right column is what we want to look at, as well as the relative importance level. So you could see final demand goods right here down 1.6%. That was a very big drop. Food, folks, down. Finished consumer, hold on a sec. That's final demand is up top at 0.3. Goods is the second one. Foods 1.3%. So goods down 1.6%. Foods down 1.3%. Consumer foods also down 1.3%. Government purchases of food actually up slightly. Not that part. No, sorry, down 0.3%. So these numbers are so tiny. Private capital equipment up 0.4%. Interesting. This is a sign of potentially more CapEx. Wouldn't surprise me to see this in, look at that. Manufacturing. Businesses are investing. That's so interesting about this quote unquote recession that we're in, is businesses are investing. They don't want to be left behind because I think they see massive economic growth ahead, and businesses are not skimping on buying the machinery they need to win over this next decade in this longer term Nike swoosh recovery. So they're continuing to invest, actually keeping pressure on machinery, private capital equipment, all of these over here, manufacturing, non-manufacturing, manufacturing growing the most. That is a big leading indicator here for optimism from businesses. You can't bet against this market right now, in my opinion. Final demand services, super nominal. Very, very good to see a nominal move here. Again, trade of private capital equipment, 0.9%. Yep, that's where you're getting the business investment. Where are you seeing losses? Final demand for transportation and warehousing. Oh, look at that. Minus 1.4%. That's great. Look at all these minuses. Minus, 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 going all the way down over here. That's warehousing. It's warehousing of personal goods. It's warehousing of capital equipment. So, in other words, the equipment doesn't have to be warehoused. Maybe it's just going to some extent, it's basically going straight to the customer. So you don't have these warehousing shortages maybe anymore, the freight shortages that you used to have. This is all a sign of the economy becoming more stable. This is great. This is very, very good. Goods for export. What do we have for export? Negative 0.9%. Wow. Services for export flat. What kind of services are we exporting? I guess that could be like legal consultancy or business consultancy. I suppose even the courses on building your wealth are kind of like consulting to some extent, right? Remember, folks, first phase of the price increase, June 16th. Probably somewhere closer to $50 for each course. That's for those of you signing up with Buy Now Pay Later, that's like a free month basically, which is pretty wild. Yeah, and then of course that's just going to be the first of 4 price increases. We're expecting to be somewhere between $210 to $300 higher by the end of these 4 price increases, because that's when we're releasing the new lectures for stocks and psych, real estate 0 to millionaire, and the making more money and getting SH9T done. Okay, continuing here. And remember to email staff@meetkevin.com if you have questions. So personal consumption, negative 0.4% over here. Government purchases of defense equipment, also negative for government purchases. Wow. Where's the heat, baby? Where is the heat? There's none left. Really, where is the heat? I think it was just in manufacturing equipment. That was really the hottest sector I saw, which again is bullish for companies. You have a little bit of potential over here. What is this 0.5%? Well, let's look at this. Oh, that's just services less. Well, yeah, but that could also include some of these capital expenditures. That's just a category. Okay, fine. Looking at some more of the individual items. What else here? Yeah, the transportation of equipment or passengers all falling. Great for CPI. Remember CPI. I want you to see that CPI chart again. Let me go to the CPI chart for a moment here. So CPI, 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 where is it? It was this. Look at the CPI chart. And then transportation services right here, actually making up a big segment of that CPI over here. So, oopsies. Big plummet here in PPI, which is actually very good. That's very good. I don't want to sound too bullish over here, but this is a good report. Okay, let me see quickly what Wall Street is saying beyond this. PPI offers deflationary hope. Bonds received a small positive jolt from PPI, which came in under expectations. And then they reiterate the numbers, which I already went through. Clearly, the Fed will need to see a lot more evidence of pass-through into consumer prices to change its mindset. But this is a good start for anyone who leans towards seeing lower rather than higher yields moving forward. Agreed. You have to see those trends. You start seeing these transportation services and that disinflation come over to the Fed, over the CPI rather. It's going to be great. Very, very good report. Here's another summary of various different stages. I mean, look at all the negative. Negative. I want to just look at the positives for a moment. Negative. And let's look at the positive. So what is this? Oh, these are stages. Construction inputs. People are building. People are betting on the next 10 years in America. That's for sure. There's no doubt about that. So the charts continue, but I think we have a pretty clear indication of PPI here. I'm pretty comfortable with what we see here with PPI. This is fantastic. I want to just quickly reiterate and then we'll take a listen to what CNBC is saying. But to have a 0.1% expectation and then get 0.3 is great. But more importantly, that really core PPI, X food, energy, and trade, your volatile categories, coming in not only at 0%, when the expectation was 0.2%, but also having a prior revision lower, phenomenal, absolutely phenomenal. So we'll see how the Fed ends up reacting to this. I think that a lot of the market today is going to be somewhat concerned with just the Fed. So I don't know how much of a market mover we'll actually end up getting from PPI.